transactions.
Our mission really is to give you a shortcut to understanding that whole cycle, from the moment an order is placed to, the final verified set of books.
Exactly. The goal isn't just to list definitions. We want to unlock the why, the context, the crucial checks, all the things that make the data reliable.
So you can walk away knowing how these complex reports are actually built from the ground up.
To do that, we have to start at the very beginning.
The foundational level, the nature of a business transaction, and the piece of paper or digital file that proves it actually happened.
Okay, let's start with clarifying some basic language because these terms get thrown around a lot.
Oh, absolutely. And they mean very specific things in finance. First up, we need to separate sales from purchases.
A sale is you exchanging your goods or services for money. That's your main goal.
Whereas a purchase is you buying goods. And that could be either for resale, your inventory, or for your own internal use, like office supplies.
And then we can zoom out a bit. Income is the broader term, right? It's not just sales.
Right. It could be interest you've earned or rent you've received. It's all the money coming in.
And its counterpart is, of course, expenses.
Which is all the money you're spending on overheads, the day-to-day running costs, rent, electricity, salaries.
But, and this is a key distinction, it excludes the cost of the goods you bought just to resell.
Exactly. Then if you just look at the cash movement itself, it's simple. Receipts are money coming in, payments are money going out.
The big umbrella term, though, is expenditure.
That covers everything, every single outflow, purchases, expenses, and even buying big long-term assets for the business.
So once we have the action defined, we look at the timing. Our sources split this into two key types.
You've got your cash transactions payment is immediate or even in advance, simple.
And then you have credit transactions.
And this is where the system gets, a lot more complicated. This is where you give the buyer a credit period, say 30 days, to pay you later.
The administrative side of that must be huge.
It is because it introduces risk. When payment is deferred, you need a very, very precise paper trail. You need to prove the debt, the delivery, everything.
Okay, so let's walk through that documentation process. Imagine a credit purchase. From the buyer's point of view, where does it start?
It starts internally with a purchase requisition. It's basically someone in the company formally saying, hey, I need this.
And that needs to be signed off on, authorized.
Once it is, that turns into the official contract, the purchase order or PO that gets sent to the supplier. It has a unique number and it legally commits you. It's a huge control point.
Then the goods actually arrive.
And with them, a delivery note from the supplier. You check the items, check the quality, and then you generate your own internal goods received note. That's your proof of receipt.
And after all that, the bill finally shows up.
The purchase invoice. Now, this is the document that triggers the accounting entry. It's the reminder of what you owe.
And the key check here is matching, isn't it?
It is the essential check. The invoice amount must match the PO. The quantity on the invoice must match the goods received note. If they don't line up,
You don't pay.
you don't pay. Not until it's sorted out.
And the final step,
Right.
when you actually send the money.
You include a remittance advice. It's a courtesy, but a vital one. It tells the supplier exactly which invoice or invoices you're paying off. It makes their life so much easier.
So that raises a pretty basic question. Why keep all this paper?
Well, there are good commercial reasons, for disputes. But the big one, our sources stress, is legal. Tax authorities require you to keep these documents for years. They are the evidence for every number you publish.
Okay, so let's move from that single transaction to the big picture, the reports that tell the full story.
Right, and we should just quickly note the different business structures because it matters who is ultimately responsible.
You have the sole trader, where the owner and the business are one and the same. They're personally liable.
Then the partnership, where partners usually share that liability. And finally, the company,
An incorporated separate legal entity.
which means the owners, the shareholders, are generally not liable for the company's debts. That separation is a massive deal.
And regardless of structure, these businesses produce two main types of accounts. First up, management accounts.
These are your internal toolkits. They're tailored, they're often monthly, and they're purely for making quick operational decisions.
Then you have the big ones, the financial statements.
These are external, usually annual, prepared to strict rules, and they go out to all the stakeholders, banks, owners, the tax office.
We're going to focus on two key statements. First, the statement of profit or loss, or SOPL.
Think of this as the financial movie of your year. It summarizes all your income and expenditure over that period.
To answer the ultimate question, did we make a profit or a loss?
Exactly. The second one is the Statement of Financial Position, the SOFP.
And if the SOPL is the movie.
The SOFP is the snapshot. A single critical photograph of the business's health, what it owns and what it owes, at one specific point in time.
So to understand that snapshot, we need its three core elements. Let's start with assets.
Assets are resources the business controls that are going to provide some future economic benefit. We split them by time.
So you have non-current assets.
Things you hold for long-term use.
Yep.
Land, buildings, machinery. You're not planning to sell them anytime soon.
And then current assets.
These are things you expect to turn into cash within about a year. So your inventory, money owed by customers, and, of course, the actual cash in the bank.
Okay, next element. Liabilities.
Yeah.
These are the business's obligations.
What it owes to others. And again, time is the key.
So non-current liabilities.
Long-term debts, things due in more than a year, like a big bank loan.
And current liabilities are what you owe in the short term.
Right. Money you owe to suppliers, we call those payables, or a bank overdraft. Things due within the year.
And that brings us to the final balancing element.
Yeah.
Capital.
This is essentially what the business owes back to its owner. It's the owner's stake. It's the funds they put in, plus all the profits the business has kept.
Minus any drawings, which is money the owner took out for themselves.
And the separation assets, liabilities, and capital, this is what sets up the entire logical structure of bookkeeping.
Okay, let's unpack this core mechanism, because this is where the real magic happens. It rests on two simple but incredibly powerful ideas. First is the business entity concept.
This is so important. The business is always seen as separate from its owner. We record everything from the business's point of view.
So if the owner buys a new TV for their house with their own money,
The business doesn't care. It's not a business transaction. It's completely separate.
and the second idea is the dual effect principle.
The bedrock. Every single transaction has two equal and opposite effects, no exceptions.
And this leads directly to the core formula of all accounting.
The accounting equation. Assets minus liabilities equals capital. And because of that dual effect, this equation must always, always stay in balance.
Give us an example of that in action.
Sure. Let's say the business buys a machine for $10,000 and it pays by check.
Okay.
Well, one asset, cash in the bank, goes down by $10,000. At the same time, another asset, machinery, goes up by $10,000.
So the total value of assets hasn't changed.
Exactly. The equation stays perfectly balanced.
And the mechanism for this is the ledger account, the famous T account.
Yep. Divided into the debit side on the left and the credit side on the right. For every transaction, one account is debited and another must be credited by the very same amount.
Now, this can be tricky because a debit doesn't always mean plus, and a credit doesn't always mean minus. It depends on the account type.
It does, and that's a huge hurdle for learners. This is where mnemonics are just, indispensable.
Our sources suggest a couple. What's a good one?
DED CLIC is a classic. It stands for debit, expenses, assets, and drawings, and credit, liabilities, income, and capital.
So those letters tell you which side to use to record an increase in that type of account.
Precisely. So if an asset balance goes up, you debit it because A is in dead. If a liability balance goes up, you credit it because L is in CLIC.
And if an asset balance goes down, say you spend cash.
Then you do the opposite. You'd credit the asset account. You always record the decrease on the opposite side.
That makes it much clearer. So once you've posted all these entries, you have to finalize the accounts.
You balance them off. You find the bigger side, calculate the difference. That's your balance carried down, or a CD, and then bring it down to the other side to start the next period. That's your balance brought down, BD.
And all of those BD balances feed into the first major check, the trial balance.
Which is just a list of all the debit balances and all the credit balances. Its only job is to check that the two columns add up to the same total.
It's an arithmetic check.
It's a proof that the dual effect was applied correctly everywhere. If it doesn't balance, you stop. You have an error, and you have to find it before you can go any further.
Let's shift now to some of the more complex areas of record keeping, starting with things like taxes and discounts.
Yes, let's talk about sales tax, like VAT. The crucial thing to understand here is that the business is just a collector for the government. It's not your income, and it's not your expense.
So you have to track two sides of it. There's output tax
That's the tax you charge on your sales. You're collecting it.
and input tax.
That's the tax you pay on your purchases, which you can usually claim back from the government.
So the figure that matters is the difference between the two.
Right. If you've collected more than you've paid, you owe the government money. That's a current liability. If you've paid more than you've collected, they owe you a refund, a current asset. That net number is what goes on the SOFP.
Okay, what about discounts? They seem simple, but the accounting is different depending on the type.
Very different. First, you have a trade discount. This is, say, a discount for buying in bulk.
And the key here is that it's taken off before the invoice is even written up.
Exactly. So you record the sale or purchase at the already discounted price. The list price never even touches your books. There's no further action needed.
But that's totally different from a settlement discount or a cash discount.
Right. This is an incentive for prompt payment. Pay within 10 days and get 2% off. It's a potential discount.
So you only record it if the customer actually takes it.
Only when payment is made or received. If you give a customer the discount, it's an expense to you, called discounts allowed. If a supplier gives you one, it's income, called discounts received.
Okay, so with thousands of these transactions happening, a large business can't post every single invoice into the main ledger one by one.
No, that would be chaos. It's completely inefficient. That's why we have books of prime entry.
These are like holding pens for transactions.
A great way to put it. They're just chronological lists. Day books for credit sales and purchases, the cash book for all money movements. The transactions sit there.
And then you post the totals to the main ledger periodically.
That's the efficiency gain. And that leads to another tool for large businesses. Control accounts.
Specifically for receivables and payables.
Right. A control account just summarizes the total amount owed by all your credit customers or the total you owe to all your suppliers. It's a high-level summary.
But it's also more than that, isn't it? It's another check.
It is an essential arithmetic check. And that takes us straight into the idea of reconciliation.
Making sure two sets of records actually agree.
The first one is that control account reconciliation. The balance on your receivables control account must agree with the grand total of the individual balances of every single customer.
And if they don't agree, you have an error somewhere.
Exactly. And the second, probably more famous reconciliation is the bank reconciliation.
Matching your internal cash book against the official bank statement. Why would they ever be different?
Oh, they're almost always different. It's all about timing. The bank statement will have things on it you don't know about yet.
Like bank charges or a direct debit that just went out.
Right. So you have to update your cash book for those. But then your cash book has items the bank doesn't know about yet.
Like an unpresented check. You've written it and recorded it, but the person hasn't cashed it.
Or uncleared lodgements. You've paid money in, but it's still processing. It hasn't hit the statement.
So what's the key takeaway? Which number is the right one?
For your statement of financial position, the cash figure you report is always the revised cash book balance. It's your record updated with all the information from the bank statement.
Finally, what happens when we do find a mistake? We said the trial balance is the first line of defense, but it's not foolproof.
Not at all. The trial balance only checks that debits equal credits. It can't see everything. There are actually 6 types of error it will completely miss.
Like what?
Well, an error of omission, you just forgot to record a transaction entirely. The debits and credits are both missing, so it still balances. Or an error of principle, you record in buying a van as a travel expense instead of as an asset.
The debit and credit were for the right amount, just in the wrong type of account.
Precisely. Now, if the trial balance does fail to balance, we use a temporary holding account.
The suspense account.
You park the difference there so you can get on with things, and then you have to investigate and find the error. Once you find it, you clear the suspense account back to 0 using the journal.
The specialized book for corrections and unusual entries.
That's the one.
So if we pull this all together, all this incredible detail, it's really about creating a self-verifying system.
It is. Mastering these recording and reconciliation techniques moves bookkeeping away from just being data entry. It becomes a structured system for producing verifiable financial truth.
All those checks, the PO matching, the reconciliations, they are the safeguards. They're what gives the final numbers their validity.
That's the crucial insight. It's what lends confidence to the figures you present to the world.
So what does this all mean for you? Well, understanding these mechanisms means you don't just know what the reports say. You know how every number in them was built, and crucially, how it was verified.
It gives you much deeper clarity and confidence when you're looking at any financial data.
And this raises an interesting question to leave you with, and it's about classification.
Our sources define capital expenditure as buying or improving an asset to increase its earning capacity. Revenue expenditure is just for maintenance.
So imagine a company spends, say, $50,000 on a new roof for its factory. How does that initial decision to call it maintenance versus calling it an improvement directly impact the reported profit for that year and the reported asset value on its statement of financial position. Something to mull over until our next deep dive.